Let's look at this question, JJG code. This is on ratio analysis, coming from the previous lecture where I explained the 4 groups of ratios you always need to assess the company or perform a ratio analysis. Now, I want to put all that theory into calculation now. Remember what I said? It goes beyond you being able to calculate ratios. Calculating ratios is the easiest thing to do. However, the marks usually come from the interpretation of those ratios. So that is what I want to give you a structure on how to deal with such a question. So let's practice with JJG code. And like I always like to start from the requirement. The requirement A says, evaluate the financial performance of JJG code. Then analyze and discuss the extent to which the company has achieved its stated corporate objectives of number 1, maximizing shareholders' wealth, and number 2, achieving continuous growth in earnings per share. All right, so 3 things are involved here: the financial performance of the company, the shareholders' wealth assessment, and EPS growth as well. Yeah, and they even made it so clear that there will be 5 marks for financial analysis, so which means you need to perform financial analysis, right? That is A. Then the B part states that if the new finance is raised via right issue at 7.5 per share, that is right price, and the major expansion of business has not yet begun, calculate and comment on the effect of a right issue on the share price. So the effect of new right issue on share price, definitely you should know that this is speaking on theoretical price. The impact on the earnings per share, would that change? We'll find out, definitely, because when they do right issue, more shares will be issued, so your denominator is changing. Then we'll see how that happens. Then debt equity ratio as well. Yeah, more right issue, more equity, and we'll see how that is going to happen. And remember, they are going to be issuing a right issue. So let's go into the details and we'll see it. The last part is just to analyze and discuss the merit and of right issue, of placing, and bonds, as source of finance. So this one, and this one. So those are the requirements. Now let's go into the meat of the question. JJG Co. So JJG Co is planning to raise $50 million, as we can see, for a major expansion, and is considering a right issue, a placing, or bond. So is that want to do equity? Equity is these 2 guys, and different forms, and this is debt. But he doesn't know which one he's going to use yet. Let's go on. The corporate objectives of JJG Co. as stated in its annual report are to maximize the wealth of its shareholders and to achieve continuous growth in EPS. Recent financial information has been given. The par value of the shares is $1 per share. The general level of inflation at 4% per year. The bonds are trading at par, $100, so which means the book value will be the same as market value. That makes life easy for us. The following are values of the business sector of JJG Co. So what they've given to us here is called the benchmark. Remember, when I was doing the theoretical part of this in the previous video, I told you, I said ratios in itself does not make any sense. You need to compare with the benchmark. And I told you that your benchmark can be sector, which means the industry average. It can be previous year, which means it's trend analysis. Or it can even be company's policy or target. But in this question, what they've given you as a benchmark is the sector information. And let me also give you this clue. Anytime they give you those benchmark, which they will always give you, you must make sure that when you do your analysis, you must calculate all the ratios for your company so that you can compare your company's ratios versus benchmark, versus benchmark, versus benchmark, versus benchmark. Don't do 3. Once they have given you like this, know that they want you to use all of them. That's why they have given you. So at the minimum, you must cover all the ratios in the benchmark. Then you even do more. Right. Now, having said that, let's go into the solving the question proper. You've seen the question. Now let's use this. So remember, three things they ask us to do. They ask us to do financial analysis, so evaluate the financial performance. Then they said we should also discuss how shareholders' wealth has been maximized and how they've been able to achieve EPS growth. Those are the three things in section A of the question. Let me show you again. You can see it. This one, and this one. So that is what we want to deal with in this question now. Good. All right. Now, starting with the financial performance. Don't get rattled, like I always tell you. Structure is very important. Very important. Start with those 4 groups of ratios that I've given you. I told you the first one is profitability ratios. I told you there is liquidity ratio, risk, and shareholders ratios. For profitability ratios, I remember I told you it's about ROCE and ROE. And for liquidity ratios, you do current ratio and quick ratio. For risk, there is operating gearing, there is financial gearing, and interest cover. And for shareholders ratios, I told you can do total shareholders ratio, which is the best. Dividend yield you can do, dividend cover you can do, and EPS you can do, and also give you price earning ratios. Yeah, you can do. So once you have this little structure, you can just drop this down quickly on your rough sheet. Then it's not left to you to decide. You don't have to do all of them. But you being able to see all of this gives you that confidence that you can do enough to score your point. Then you go into the question. You have information to do ROCE. You have information to do ROE. That's what we need to do. Let's look at it. Let's split view so it makes life easy for us. Yeah. Now let's look at it. Do we have information for ROCE? ROCE is PBIT, which we have here, over capital employed. Capital employed is equity. We have equity, ordinary reserves and reserves. Those are equity. And we have debt. So we can deal with this. This is PAT, profit after tax over equity. We have profit after tax, which is earnings. So we can deal with that. Current ratios is current liability over current asset over current liability. We don't have that information. We can't do this. Likewise, we can't do quick ratio. So we know that we're not going to be looking at liquidity ratios in our analysis. Operating gearing, we need our fixed cost to be able to do that. Yeah. Contribution, can we do contribution? No, that we cannot do contribution. So we have information on contribution. We can't do with this contribution. We only have PBIT. So operating gearing cannot be done. Financial gearing is debt equity ratio. Now, I told you for debt equity ratio, there are 2 ways of doing it. It can be simply debt divided by equity, or it can be debt over debt plus equity. Sometimes they tell you directly what to use, but if they are quiet, just check the benchmark, then you will get a clue. See the benchmark here is debt equity. So which means when you are doing your own, you do debt equity. Another trick they bring here is whether are you going to be doing it using the book value or market value. You can see the benchmark you have is market value basis. So which means you need to be using market value of debt and market value of equity in your calculation as well. So please take note of that. Then interest cover is PBIT over interest expense. We have PBIT. Interest expense, we can calculate to 8% of the book value will give you interest. So we have information to do it. Whether you want to do it is a question, but we have enough information to do that. Now, for shareholders' wealth, we have total shareholders ratio, which means we need dividend per share, and we will need capital gains, which is previous price taken away from the current price. We have all the historic prices, so we're able to get capital gains from this part. Yeah, so which means we will be good because we have that information here. All right, so this is price. We'll be able to get capital gains. So all of that divided by the opening price. So we'll be able to do price total shareholder ratio, which will take care of this easily. That total shareholder ratio is enough for maximizing shareholders' wealth. right? Then because we have dividend information, we have price information. Then specifically they're asking for EPS here, so we'll do EPS as well. So if you take total shareholder ratio here, EPS enough for shareholders. Then for risk, we can do financial gearing, and for profitability, we'll do ROCE and ROE. That will be enough to score our marks. 5 marks of financial analysis, we'll be fine with that because we would have done more than 5 ratios anyway. So now let's go into the calculation. Yeah. So very important to be very confident. Yeah. Remember, benchmark must be fully used, and watch out for the debt equity ratios. The basis of the benchmark is the same basis you should use for your calculation, so that you'll be comparing likes with like, right? And not comparing apple with orange. Very important. Yeah. Now, how do you do financial analysis? That's another place that I know I've seen students struggle. Financial analysis with ratio. I'll just give you a structure to it. Yeah. What that you should always take note. Number 1, yeah, is calculate the ratio. Please take note. So calculate the ratio. Once you have calculated the ratio, the next thing to do is ask yourself a question. You have this ratio in front of you. What can you see? What can you see? And I will tell you what this means. When I say what can you see, you need to talk about interpretation here, which means, is this ratio, has it been increasing or has it been decreasing? Is it greater than your benchmark or is less than your benchmark? You need to talk about that. What can you see? What trend can you see? So say something about what you have calculated. This ratio has been reducing or it has been increasing, or is less than the benchmark or is higher than the benchmark. Say it. It's as simple as that. Ratio analysis is pretty simple. Then the third thing to do is possible whys. So explain possible, because you are not there. So we are not expecting you to tell us with 100% assurance that this is the reason why this ratio is this. But you need to be able to reason and say some sensible why, some sensible reasons why that ratio is increasing or is decreasing or is having that value that you have calculated. So explain possible why. Remember, I said possible why because, like I said, you are not expected to know for certain why the ratio is like that. So these are the 3 things you think about. Remember, the first thing is have this summary structure of all the ratios you can ever need in your financial analysis. For FM, it's not beyond this. Then identify the ones you want to deal with based on information that you have. Then once you start your financial analysis, you start calculating each ratio, explain what you can see, increase, decrease, greater, less than, and why. That is it. Your financial analysis will be perfect. So that is exactly what we want to do right now. And that takes me straight to the Excel computation. So I've tried to summarize it in this table in terms of what we'll be doing now. We need to start populating this table based on the information that we have. So this is JJG, and we need to, first of all, populate our benchmark. So we'll be looking at PBIT, we have it profit after tax, we populate it, dividend, book values, yeah, all the information that we need for our ratios. Yeah, we said we're going to do ROC, we're going to do ROE, debt equity at market, we'll do interest cover, dividend per share, because we need total shareholder ratio, because we need these two to be able to get this one, right? So we're going to be using all of that. Yeah, then EPS as well, we're going to see how it's been growing. Yeah, so these are the ratios we need to calculate, but let's quickly put the benchmark for each ratio. Interest expense, we don't have a benchmark for that. So ROCE benchmark is 25%. ROE benchmark is 20% in the industry. The market value of debt equity ratio is 50%. At market value, debt equity ratio is that. Interest cover, yes, we have that 20 times. Dividend per share, we don't have that. Capital gain definitely, but TSR, we have 14%. Remember, the benchmark for total shareholders returns will be the required return from the shareholders, and that is using the capital asset pricing model for the sector is 14%. So we have those benchmarks, and now we can start to populate our information. Yeah. So PBIT for 2008. So we have 9.8, 8.5, 7.5, 6.8. Then what is next there? Our profit after tax, 5.5. 0.6. Yeah. Then dividend, the total dividend paid. So total dividend paid for 2008 is 2.2 million. The book value of equity. The book value of equity is not just your share capital. Remember, it's always share capital and the reserves, all the reserves. So here it's going to be, for 2008, it's going to be 5.5 plus 13.7. That is the total equity for 2008. The debt is there, is given 8% bonds, redeemable is 20. For market value of equity, we have to calculate that, which will be price of shares multiplied by the number of shares. A number of shares has been given here. We can populate it as well. Number of shares, we have it. Where is it? Okay, they didn't give us number of shares, but they gave us the ordinary share capital, 5.5. But they told us that the par value is $1. So if the par value is $1, that means they have 5.5 million shares. So that makes it easy. So like this, you're just saying 5.5 divided by 1. So that number of shares equals to 5.5. Yeah. And share price for 2008 is 8.64. Is given. All this information are given there. Yeah, 8.64 for 2008. Now let's get the market value of equity, which will be share price multiplied by the number of shares. So we have that as the equity value, market value. And market value of debt is going to be number of debt multiplied by the market price of the debt. And in these questions, we have been told that the bond is trading at the par, so which means that the book value will be the same as the market value. So in that case, it makes life easy for us. Well, if I'm just to show you why it's like that, let me just show you how to do it in case you have a question that is not book value equals to market value. Yeah, so to get the number of bonds, you say the number of bond will be equals to your book value divided by the par value, and that's 20 million divided by 100. Then that will give you the number of bonds. To get the market value, you multiply by the price of the bond. In that case, they said the price of the bond is also 100, and that's why you can see it's 20. So this is the way I'm going to populate for the other years, 2007, 2006, and 2005. Now we have the information that we need for the ratio calculation. These are all information from the question. Yeah, the only one we've had to do some calculation on is probably the market value here, which you already know how I got them from what I've done. Now let's calculate the ratios. Interest expense, let's calculate interest expense. To start with, interest expense was 8%, is there in the question. They gave us as 8%, yeah, of the bond. So the 8% of the bond value, which is 20 million, will give us the interest expense. So in that case, that is just doing equals to 8% multiplied by the bond value, book value, which is this. So we have that, and that will be the same for every year. Yeah, that will give us the interest expense. And for ROCE is PBIT, so which equals to PBIT, this one, then divided by the capital employed, which is the book value of equity plus debt. And that gives us the ROCE. So this should be in percentage. And that will be the same for all the years as well. You can see ratio analysis is easy and sweet, especially on Excel. And I advise you to practice on Excel a lot. Return on equity is profit after tax, which is the same thing as earnings, divided by the equity. And we have the equity here, easy. So that gives us that figure as well as the return on equity. And the same thing we will do for all the years. Right. Let me just put it on percentages as well. Yeah. And the next one is the debt equity ratio, which is book value. And that means you just have to do debt of market value divided by the equity. Yeah, and that will be the same as well for all the years. Yeah, remember it has to be in percentages. Easy. Then interest cover is PBIT divided by the interest expense. Remember, I told you don't need to memorize these formulas, because if it's interest cover, what is covering the interest is what you are paying the interest from, and you are paying that interest from whatever you have as your PBIT, and we already calculated the interest expense here as well. So that is number of times that the PBIT is covering our interest expense. So that means for 2008, the PBIT can pay the interest expense 6 times, and like that for all the other year. Yeah, dividend per share is total dividend divided by number of shares, which is this. So we have 0.4 for 2008, and likewise for all the other years. Very easy. Yeah. Okay. So capital gains is the closing price minus the opening price of the share. So in this case for 2008, we closed with 8.64 31st of December, but 1st of January 2008, that is 5.74 what we open with. So that is the gain for 2008. And we have on the 2006. We will not be able to have for 2005 because we do not have the opening for 2005, which would have been the ending of 2004. So that will end there. That means our TSR will not have for 2005. We're only going to have for 2008. So remember your TSR formula. Remember, is equals to your dividend per share plus your capital gains, everything divided by your opening price. Yeah, please take note, don't make mistake. The popular error that I've seen people make is that because the way the formula is written, sometimes people do the dividend per share separately and only divide the capital gains by the opening price. That will give you a wrong answer. So you have to divide both of them by the opening price, because remember, the shareholders has made gain of dividend and of price appreciation by investing the opening price. So for TSR, what we have to do is to add the dividend per share plus the capital gains, then all of those benefits divided by the amount we invested beginning of the year. And that gives us the TSR for all the years. No, for except 2005, because we didn't have opening, right, for 2005. So we won't be able to do that. And that we also record it in percentage. So for EPS is easy. It's earnings per share. And our total earnings is profit after tax. And the total number of shares, we have it here as well. And we have EPS for all the years. Likewise. So that is our EPS. So practically, we are done with the ratio calculation.